Welcome back, or welcome to this lecture if you haven't seen all the previous ones. This is the 10th lecture in a series of 10 which will be given to undergraduates starting a course, a degree in banking and finance. So it's very introductory stuff. And this lecture and the previous lecture are about the framework within which financial markets and the financial services sector works. And that framework is created by central banks. Now, the financial services sector, indeed the whole economy, wants prices to be maintained in a stable way. It doesn't want deflation, a fall in the average level of prices. It doesn't want inflation, a rise in the average level of prices. I explained in the last lecture, and this one is not something that all economists agree about, but it is of course correct because I wouldn't tell you otherwise, that central banks are totally responsible for all deflations and inflations. It can't be anything else other than that, because a deflation is just less units of money used in the same number of transactions, and inflation is more units of money in the same number of transactions. Note, more or less units of money. The central banks take control, manage the number of units of money in an economy. So when you get your deflations or your inflations, they must be, by definition, caused by the central bank. Now, this lecture is going to be entitled Central Banks, Inflation, Hyperinflation and Depressions. Again, not something that will be agreed by all economists, because there is a sort of myth perpetuated by Keynesian economists that inflation is good because it expands demand and it creates the conditions that move you towards growth, a boom in the economy, and it's the very thing that you need to get rid of depressions. But I'm going to go through an example in UK in 1970s, which shows you it's the very opposite. If you destabilize prices in a downward direction or an upward direction, then you will eventually cause depressions. Inflation can be beneficial at a very, very low level. I'll explain why a little bit later on. Deflation, not so. But basically, both of them will end up in depressions if they get out of control. So what we're going to do is concentrate in this lecture on inflation. And I'll explain firstly why inflation is a problem. I'll explain why hyperinflation is an even bigger problem, hyperinflation being inflation that's just accelerating and accelerating at faster and faster rates. I'll go through one example in detail about the inflation that occurred during the 1970s in the UK and caused a depression, but a depression with inflation, which would be called stagflation. And I'll explain the causes of hyperinflation and why hyperinflation destroys currencies, and that will just take us over the world rather than leave us here within the UK. So what is inflation? I've said it once, but it's very important, so I'll say it again. Inflation is a rise in the average level of prices. It is more units of money being used in the same number of transactions. Therefore, you cannot have inflation unless you have excessive units of money. It would be impossible to have inflation in a barter economy. A barter economy would be one without money, where you would just trade, shall we say, one apple for 2 oranges. And if one apple traded for 4 oranges rather than 2 oranges, then the apple has doubled in value, the oranges have halved in value, the average stays the same. You cannot get inflation or deflation in an economy which trades, but trades without money. It's money which causes the inflation and the deflation. It's also, and again this is a tough one because Keynesians have to assume there is such a thing as cost push inflation, that there's something that can push up prices like wages, like oil prices, but I'm going to tell you it's impossible to have cost push inflation, because higher oil prices or higher wages don't increase the amount of money in the economy. They take a bigger share of that money that's already in the economy, leaving a smaller share for other people. And prices are changing in a relative sense, some going up, some going down, but the average is not changing unless the central bank does something to change the number of units of money in the economy. Now, the problem with inflation is that it distorts and masks relative price changes. Relative price changes are those prices that go up and others that go down, and they are important market signals in an economy. Now, what that means is that if we caused some inflation but people didn't anticipate inflation, individual firms would look at this rise in demand and see this is a rise in demand for our product because there's been a fall in demand somewhere else in the economy for somebody else's product or a competing product provider. And so the firm sees an opportunity to raise prices, increase profit margins, expand output. Now, when all firms see exactly the same thing, their immediate response is to push up prices, increase profit margins, expand. But when all firms try and expand output, there's a sudden increase in the demand for the productive factors. So all the prices of the productive factors, the land, labour, capital resources used in production, they'll go up in price and erode that profit margin and push you back, if you like, into a previous level of profits and a previous situation where you will probably wish you hadn't expanded. You had taken advantage of higher prices, but you hadn't expanded. So when you don't anticipate inflation, it creates a problem because each individual firm thinks it's the market telling that firm to expand its output. But it's masking the market signals, and it's telling all firms to do the same thing, which tends then to lead through to the inflation and push firms back into the position that they were in before there was this boost to monetary demand in the economy. So if you then start to anticipate inflation, you know it's coming, you act differently. You don't expand, you just keep pushing your prices up, take a short-term increase in your profits, and then when your costs go up, you move back into the previous situation that you found yourself in. Inflation, because of its action, it indiscriminately redistributes income and wealth. Now, when I say indiscriminate, I mean no one plans this, no one makes a decision to do this, it just happens. When you get inflation, let me remind you, income is that stream that you receive from, shall we say, working, and you'll get it every week or every month in your wage or in your salary. Wealth is just what you own, so you're bound to be a lot wealthier the older you are if you've collected things. So wealth is what you own. Now, inflation redistributes the value of wealth, because if you happen to be holding all of your wealth in the form of units of money, they're now going down in value. So you're going to become worse off. However, if you translated all of that money into, say, gold and property, them being real things, they will keep up with inflation. So you need not necessarily have any fall in the value of your wealth. And you'll probably have an increase in the value of your wealth, because what happens is speculators come into this and say, we've got to get out of cash, we've got to get out of money contracts, and we need to hold property, we need to hold gold. So an increase in speculative demand for those things usually means that your wealth increases if you're holding real assets rather than money assets. Income Equally, if you have, say, an index-linked income, or you're part of a strong, powerful union who can keep wages ahead of inflation, you won't become worse off, you may become better off. But if you're in a weaker bargaining group, suppose you're doctors and nurses and you don't go out on strike, so you don't really cause problems, then a government might tell you that in order to get inflation under control, we've got to stop putting wages up as quickly as possible. So you end up losing out to those people who are powerful enough to get wage increases during a period of inflation if you're not powerful enough. So what happens is, over time, you're going to get this redistribution taking place, and it takes place in an indiscriminate way. Now, many economists will call inflation a tax. They'll say inflation is an unconstitutional tax on money. Unconstitutional means it wasn't voted for by Parliament, it wasn't put in the manifesto of any government. It's just something that happens inadvertently. Those people with money find the value of that money falling, and equally the prices rising will increase VAT returns, so the government ends up getting more tax back as the result of inflation. So inflation isn't a bad thing for everybody. Inflation benefits people who hold their wealth in the form of real assets. It benefits governments who get an increase in their taxation, and you can think of inflation as just something that reduces the value of money, and I'd like to describe that as an unconstitutional tax on money, because then you really begin to understand some of the damage that inflation can do. Now, inflation also has damaging effects on the current account of the balance of payments, those flows that are measured when exports leave the country and earn you income, and imports come into the country and lose you income. And if all countries inflated at exactly the same rate, then there wouldn't be much effect on their exchange rates. But if one country is inflating by 10%, all other countries are inflating by 5%, you'll expect the country with the higher inflation to see a fall in its exchange rate. Equally, you'll see countries which have inflation but at lower rates could even see a rise in the exchange rate of their currency. So inflation has a distorting, damaging effect on the balance of payments, and it would usually mean a depreciation in the exchange rate. But it doesn't always mean that, because if you are inflating at a rate that's slower than everyone else, that could actually be associated with an appreciation in your exchange rate, not a depreciation. So it isn't de facto inflation leads to a depreciation in the exchange rate. It may also be associated with an appreciation in the exchange rate, but either way you're distorting prices. Now, as inflation reaches high rates, as it becomes more volatile, so it tends to damage job prospects, because it's masking, it's hiding what's really going on in the economy, and so it can damage job prospects, it can increase unemployment, it can slow economic growth, it can cause stagflation, that situation where you have slow or no economic growth, rising unemployment, and you have inflation as well. Now, if we looked, say, at the last century in the UK and looked at inflation, we need to note, firstly, that every single inflation has been caused by a central bank, or in the case of the UK, the central bank, the Bank of England. We mentioned it briefly in the previous lecture, because World War I created lots of inflation. Prices inflated through World War I, by around 100%. That was all caused by the government going to war and financing it by printing money, and the printing money was allowed by the central bank. So rather than tax, rather than borrow, you just produced government debt and printed money to the value of that government debt, and that caused World War I inflation. Deflation followed. That was described in the previous lecture. So there was no more inflation between the world wars. In fact, the very opposite, because of the mistakes made by the Bank of England causing deflation in the UK, and then the mistakes made by the Federal Reserve after the Wall Street crash causing the Great Depression. So there was no period of inflation between World War I and World War II. And after World War II, there was very little inflation, some inflation, but very little inflation, because Bretton Woods set up the gold exchange standard. And the gold exchange standard fixed exchange rates and made it very difficult for countries to do the only thing that causes inflation, which is increase monetary demand, print more currency, expand money in the economy. You can't do that when you're on a fixed exchange rate and a gold exchange standard. So again, no inflation after the Second World War, right the way up until the beginning of the 1970s. The beginning of the 1970s being a period of time where you left the gold exchange standard, left the fixed exchange rate, and allowed exchange rates to float. So we do have inflation in the 70s, and I'm going to deal with that in a little bit more detail in a moment. And at the end of the 70s, we really discredited Keynesian economics, and we put central banks under a lot of pressure to control inflation, which they have been able to do. Not necessarily the best way, as I've described again, I think it was lecture 8, where I explained that. So we've had no real inflation, but I also suggest that we might have inflation in the system now as a result of the 2020 pandemic, which will come out in 2021, 2022, remembering that there's that time lag between putting money into the economy and it filtering through and having its final effect on the average level of prices. So basically, there's only one good example of inflation during the last century in the UK, and that was the 70s. So let's look at the 70s and look at what happened. And it's actually necessary to understand the sort of debate between the Keynesian economists who caused the inflation of the 1970s and the monetarists who explained to them that they were causing inflation and said you shouldn't be doing that. See, monetarists say all inflation it's always caused by monetary demand growing faster than output. There's no other cause other than monetary demand growing faster than output. For Keynesians, that's different. In fact, for them, monetary demand must grow faster than output. They need that to close output gaps, to stimulate the economy, to grow the economy, to raise employment levels. Now, they were saying this in the 1960s, but the Keynesians were frustrated by a fixed exchange rate. You had what was called a stop-go cycle, attempts to try and stimulate demand in the economy by loosening fiscal policy and loosening monetary policy, the accommodating monetary policy that the Bank of England allows. But you had to stop. You had to stop because the exchange rate came under pressure. So I suppose more correctly, it should be described as a go-stop cycle rather than a stop-go cycle, because you tried to go and then you had to stop. So Keynesians were frustrated during the 1960s and said, no, just let us constantly and steadily expand aggregate monetary demand, and if the exchange rate comes under pressure, well, push it aside, just let the exchange rate float. Now, they had some good luck, if you like, because the Americans financing were finding it very difficult to maintain the gold exchange standard. So by June 1972, the world was floating its currencies, in our case floating downwards, but it was floating its currencies, and there was no longer a fixed exchange rate. So the Keynesians said, right, we're ready now, listen to us. This is what you've got to do to cause your economy to grow. We need fiscal deficits, that is, we need the governments to spend more money than they take in the form of taxation. So the government goes, great idea, I think there's lots of votes there. So they agree to do that. And we need an accommodating monetary policy. We need the Bank of England to accommodate our fiscal deficits, which means we need you to keep interest rates low, boost the liquidity in the system, print money against some of this deficit to boost demand in the economy. And the target was, if you let us do this every year, we'll be able to hit 5% economic growth. We hadn't done that before. We've been growing at 2 or 3%. Now, we can target 5% economic growth as long as you let us expand aggregate monetary demand without any concern for the exchange rate, which is exactly what happened. Now, the initial effect of boosting aggregate demand means that you get some inflation, but it was unanticipated. And I've already explained that unanticipated inflation gets firms in the mood to push prices up, increase profit margins, expand until they realise what's going on, and then they contract back again. So the initial effect, we had unemployment drifting over 1 million, and very quickly, once we started stimulating demand faster, unemployment fell back to around 600,000, but then gradually it crept up again and went in above 1 million when we really got the stagflation taking place. Now, why does it happen? Remember, if you're a monetarist, every single time you get inflation, doesn't matter how high or low it is, it's because you've got too much demand in the economy. So even now we've got only 0.3 or 0.8, depending upon which measure you believe, inflation. We still have excessive demand causing that inflation. It's very low, but we still have excessive demand. However, if you're a Keynesian, that's not the case, because if you've got some unemployment, an output gap that you need to close, if you're only growing at 2% and you want to grow at 5%, then you need to boost demand. Now, suppose you boost demand and the initial flurry is that you get 5% inflation. As far as the Keynesians are concerned, that isn't caused by excessive demand in the economy. They'll measure cost push inflation. They'll measure costs rising and say, right, we've had this year 5% cost push inflation, which means that we need to expand monetary demand by at least 5% to accommodate all those prices that have been pushed up. And we need, shall we say, another 5% in order to stimulate growth. So we expand demand faster and the money supply grows quicker. And then next year we get 10% inflation. So the Keynesian argument is then, right, we need 10% growth in the money supply to accommodate last year's cost push inflation and another 5%. And then we get 15% inflation. And then we get 20% inflation. And then we get 25% inflation. That is exactly what happened in the 70s. We got up to almost 30% inflation before we stopped blaming cost push inflation, started to blame Keynesian economists for pushing accommodating monetary expansions throughout the 70s. And the 70s quite clearly proved that all inflations are bad for an economy. And it finished off, if you like, the idea of Keynesian economics but it did come back a little bit later on when we'd forgotten all about the mistakes, because our universities continued to teach the theories of Keynes and of Keynesian economists. The universities were sitting back to advise again when it came to the global financial crisis. Let's go for a fiscal expansion. Didn't work then either, never worked last time. We seem to have forgot the 70s by the time we get to 2009. We do have a target for inflation, which is 2%. I'm quite happy for that target to be there, but it's not a good thing. Ideally, you would like zero inflation, zero deflation all the time. Then the price system works best. Market signals work best if you've got no inflation at all. But, as I said to you in the last lecture, if you've got a little bit of deflation, that tends to change people's perceptions and makes them act in a way that's likely to cause that deflation to get worse. So if you target 0% inflation, you're going to get some deflation and some inflation to produce that average of 0. You don't actually want any deflation. That sends out the wrong signals. Japan tried for many years to target 1% inflation but kept dipping into deflation. And so almost all countries now target 2% inflation. I'm quite happy with that, but it's still damaging. It still has all the effects that I described previously about inflation. So it's not something that has got rid of the problem that you associate with inflation. It's there, but a target of 2% a year, steady and stable, is probably the best we can hope for all the time that we allow central banks to manage our rate of inflation. And of course, think about it. Central banks, or the Bank of England, Federal Reserve, have targets for inflation. They only have targets for inflation because they know they can achieve their targets. They can't control wages, import prices, oil prices. So if they were the cause of inflation, a central bank would say, no, nothing we can do about inflation. But the central banks say, yes, we will control inflation because they can. It is actually the only thing that they can control from my perspective, although, again, there are some economists who will disagree with me. So it is really the only good example of a sort of sustained period of inflation in the UK in the last century, to look at the 1970s and see inflation isn't a good thing, and it does damaging things for the economy. Now, it's a little bit off-piste, I suppose, but I do like to throw this in because everyone loves this when it appears in my lecture. And if you've listened to my economics lectures, you would have heard this, but if you haven't, then this will be new to you. And it's about the way that we actually measure that inflation that we're talking about, this 2%, because we measure it incorrectly. There are historically two measures of inflation in the UK. One is the retail price index, and the other one is the consumer price index. Now, for many years we measured inflation as a retail price index, and the retail price index, not perfect, nowhere near perfect, but it is much better than the consumer price index. If I asked you why, you'll say, I know why, because there are different things, aren't there, in the basket of goods that you measure on the consumer price index and the retail price index, and there are marginal differences. In fact, they're so marginal they make hardly any difference to the rate of inflation, would make a small. It's nothing to do with that we get it wrong. We get it wrong because we changed from measuring inflation with an arithmetic average to measuring it with a geometric average. Now, I'm sure some bright young statistician in government said, look, I've worked out that if we calculate inflation this way, it'll seem about 1% lower than it really is. And it's also happening on the continent already. So why don't we change the way that we measure our averages, and we'll call the retail price index the consumer price index. and that will be of great benefit to government. It doesn't benefit anyone else, but it becomes a great benefit to government. And let me explain to you so that you understand this difference. So a bit of maths involved here, but do your best to keep up with me. I know this can be a bit tough. If we were trying to work out an arithmetic average for two numbers, suppose there are only two things in the economy and they were both trading at £4 each. If we wanted an arithmetic average of those two products, we do the maths. So if you want to check these on your calculator, so if you add 4 and 4 together, you get 8. And if you divide 8 by the two products, you get 4. So your arithmetic average of these two products is 4. If you want to do that geometrically, a geometric average of those two numbers, it's not 4 plus 4 now, it's 4 times 4, which equals 16. You then take the square root of 16 and you get 4. So the average is the same. Thank goodness, to start with. Now just suppose one of those prices doubled and the other one halved. So now the two prices, instead of being 4 and 4, are 8 and 2. If you want an arithmetic average for 8 and 2, it's 8 plus 2 equals 10 divided by 2 equals 5. The average has gone up from 4 to 5, which if you wanted to record that as inflation, because you can, it's two products, not one. If you want to record that as inflation, it's 25% inflation. They've gone up from 4 to 5. So we've got our 25% inflation with our arithmetic average, and that's a fair representation of a fall in the value of money, because originally I needed £8 to buy these two products. Now to buy exactly the same products I need £10. So each unit of money has fallen in value as inflation has risen by 25%. I hope you're all with me so far. Geometrically, this is where the fun is. Geometrically, that's 8 times 2 equals 16. Take the square root of 16 and you have the answer 4, and you have no inflation at all. Same numbers. I had 25% inflation. If I measured it arithmetically, I now only have 0 inflation, measuring it geometrically. Now you don't actually, when you have sort of 3,000 products in your basket, have that same dramatic effect. But look at the statistics. You will find that CPI is usually up to a percentage lower than RPI. And what I'm telling you is RPI is the better measure of inflation and changes in the value of money. CPI undervalues that. So why do we do it? We do it because that's what government like. They want inflation to seem lower than it really is. And there are actual benefits to government of having a lower rate of inflation measured than it really is, because if they've index linked things, they'll have to pay out less. In fact, all teachers, university lecturers, your index-linked pension now goes down in value every year because it's linked to CPI. As a saver, your national savings goes down every year because on the index-linked savings, they've linked it to CPI instead of RPI. So there's less to pay out. Students, of course, beware, because your student loans are still linked to RPI, so you've got the more to pay back. But the government has to pay out less if we can change this number. In fact, almost all public sector pensions are now linked to CPI, except one I can think of. And the one that I can think of that's still linked to RPI is the Bank of England's pension. no other pensions are, but the Bank of England is. I managed to question them in a debate with members of the Monetary Policy Committee, and I was. So I didn't actually question them. No, it came out in the lecture, and afterwards, one of the Monetary Policy Committee members whispered to me, "RPI is still the way we measure our pension at the Bank of England," which was quite interesting, and my natters with the Monetary Policy Committee are all done under Chatham House rules, so they couldn't be reported anywhere, so you shouldn't really be listening to me now, and certainly don't pass this information on to anyone else. But someone found out about it and questioned Mervyn King when he was at Wimbledon having his strawberries and cream, and he did say, quite rightly, the Bank of England pension system is a private pension system. It's not a state pension system, and I would not disadvantage the members of this pension scheme by linking them to CPI, which is why the Bank of England pension remains linked to RPI, because RPI is the truer value or the truer measure, of the value of money. So the Bank of England pensions will continue to rise so that the real value is maintained, but teachers and lecturers, hard luck, yours is going to keep going down every year from now on. Let's move on to hyperinflation, because again, there is only one cause of hyperinflation, and that's a rate which is accelerating, and the speed it accelerates it's limited often just by the number of printing presses you've got and the speed that they can turn out the money. There is unfortunately a growing theory within economics, modern monetary theory, which tells government what they want to hear. Keynesians tell government what they want to hear, and what they said didn't work out. It's going to be the same for modern monetary theorists as well. And if you ask them about hyperinflation, they say no, hyperinflation has many causes. It's not just the one cause. And what, of course, modern monetary theorists do is they miss out critical step 2. Some of the examples I'm going to give you of hyperinflation all go back to supply side shocks, weak governments. They go back to a variety of things that caused the printing presses to be turned on. It is the printing presses being turned on, step 2, which causes, step 3, the inflation. If we had all these supply side shocks and we had all these weak governments and they didn't turn on the printing presses, you wouldn't get hyperinflation. You only get hyperinflation because you turn on the printing presses. There is only one cause of hyperinflation, and that's just printing money much more quickly than the output of the economy is growing. And if there's a supply side shock that contracts the output of the economy, the inflation is even higher because there's even more excess money in the economy. So I've written an article about this explaining why modern monetary theory is wrong not to understand this, but I have continual arguments. They still want to say no, there are many causes of hyperinflation, and I say no, there isn't. There's only one. It's just printing presses that cause hyperinflation, and what you're missing out is you're talking about what caused the printing press to be turned on, and it's the turning on of the printing press that causes the hyperinflation. What caused that to happen? There's a whole lot of different reasons for that. As we can see, if you sort of look up hyperinflation, it's fairly arbitrary, but it would be stated that about 50% inflation a month above that is hyperinflation. Well, you have had well above that some really great examples. I've explained one of them in another lecture. In Germany, between 1914 and 1926, we reached a monthly rate of inflation, not a yearly rate, a monthly rate of inflation of 29,500%. 1914, war, Germany goes off the gold standard. After the war, it's got a lot of war reparations to pay, a lot of rebuilding to do. government is weak, it starts printing money, and as it prints money faster and faster, of course, the rate of inflation goes up and up and up until we get to 1926, when all of a sudden it stopped because they stopped printing money. They changed the currency from a Reichsmark to a Deutschmark, and Germany have been one of the best countries since 1926 at controlling inflation, and their influence on the European Central Bank, I'm sure, is very strong because they know what caused hyperinflation, and it's not going to happen again in Germany. So it's a great example, the Weimar inflation, and great stories about what went on at that time. Stories like having to go down to the baker's, pushing a barrow load of money in order to buy your bread, and the person made a mistake by leaving this barrow load of money outside a shop when they went in, and when they came out it had gone. Not the money, that was useless, that had been tipped out. The barrow had gone because that was a real thing. That's what inflation, hyperinflation does for you. Greece, between October 1943 and December 1944, its monthly rate of inflation was 13,800%, and World War II was cited as the reason that a weakened government got into printing lots of money. Hungary, the August 1945 through to July 1946, it reached a daily rate here of 207% a day. It claimed it was a supply side shock after the First World War. It destroyed the currency, Second World War. It destroyed the currency, so the pengo was replaced by the forint, and things got back to a little bit of normality after that. Zimbabwe, March 2007 to November 2008, its daily rate of inflation was 98%, and government profligacy and inability to raise taxes meant that a very weak government in Zimbabwe printed money and caused that inflation. Or going back a little bit, Yugoslavia, between April 1992 and January 1994, it reached a daily rate of inflation of 64.6%, and the reason was the disintegration of Yugoslavia into its component parts. Argentina has been a really good example of a South American hyperinflation, although technically it may not have got to 50% a month. It did over certain months, but if you look at Argentina, it's a continuing problem of inflation. From 1975 to 1990, it only reached 300% inflation on average per year, but there were some months where the inflation went above the critical 50% to be defined as hyperinflation. I had some friends, or hopefully I've still got them, who were in Argentina back in the 70s. My university friend Lee and his girlfriend of the time, Jackie, they were teaching and wandering around Argentina, and they wrote me a letter at the time, which is here, and they were geographers, so they obviously didn't understand economics, but he wrote, when we arrived in Argentina, the exchange rate was 125 pesos to the dollar, and when we left 3 weeks later, it had risen to the unbelievable figure of 260 pesos to the dollar, and was still rising, so that now you can get 300 pesos to the dollar. And I always imagine, because it was a long letter that they wrote, that by the time that they finished writing this letter, it had actually changed from 260 pesos to the dollar to 300 pesos to the dollar. I don't really know, but they were confused. Good example of Argentina and its very high rates of inflation, which did go above 50% over some months and have carried on for a rather longer time than most other countries' hyperinflations. And remember, all of these hyperinflations were caused by monetary demand growing faster than the rate of growth of output. Now, if you want financial services, if you want your economy to function efficiently, you've got to get rid of deflations and inflations. I have absolutely no doubt, but remember, lots of economists disagree with me. I have absolutely no doubt that it is the central bank which is totally responsible for deflations and inflations. That is, it is the one thing they can do. I've said central banks can't create jobs, they can't grow economies, they can't make things better by printing money, but they can certainly make things worse by printing money. So what I always want of a central bank is maintain stable prices. I'll let you off up to 2%, but past that, leave it at that, and always be limited in what you do by the fact that you cannot allow inflation to go above 2%. So that, if you wanted to sort of turn off now, you've had enough, that's more or less the end of this series of lectures on banking and finance, or money, banking and finance, and it did really finish off by castigating, unfortunately, the incompetence of central banks, and hopefully if they listen to this then we might get some changes into the future. I will at this point just, if you're really interested in trying to develop and understand some of these points which I haven't been able to deal with in a lot of detail, send you to my blog. So you can find my blog at jbhearn .wordpress.com, and then you can find all of my blog articles. And let me, if you don't want to read all my blog articles, just point out a few of them to you that explain the things that I've been talking about in these lectures in more detail. If you want to, please go in there and argue with me, say no, you got all this wrong, and explain why, so that we develop our understanding of this subject by some mutual interaction. But what I've already talked about, there is an article on the blog called What Really Happened in the 70s, so you can understand what really happened in the 70s by reading that article. None of them are too technical or too long, so you should be able to get through them in half an hour or so quite easily. There is another one which is understanding monetary policy, and it says a synthesis of the old and new. It was quite easy to control monetary policy if you go back to, say, the 1960s, because you had an easy way of doing it in as much as the bank controlled the amount of cash in the financial system and therefore had some control through the money multiplier over the total amount of money in the economy. And of course things are different now, and things there is a new system here, but I would go back and I would try and produce these two controls together, because remember, all I want the bank to do is control monetary demand. I don't want it to try and do anything else, and if it can do that, the economy will then be in the best position it possibly can be to grow, and to grow more quickly and satisfy all our demands for a better standard of living. Quantitative easing. There's a lot of misunderstanding around quantitative easing, so there's an article in there called Understanding and Misunderstanding QE. If you go to the Bank of England and ask about quantitative easing, they'll give you a nice little pink book which tells you all about quantitative easing, and nowhere does it say it's caused by printing money. It talks all about the electronic transfers and how, in fact, it actually says this is not money printing, but it's exactly money printing. Quantitative easing is printing money and buying back second-hand government debt. And although all that money isn't physically printed, if it's, say, left in reserves at banks, all those reserves are 100% backed by cash. So if you say, give me the cash, they would have to print it. So it's exactly the same as printing money. So there's a lot of misunderstanding about QE. There are actually good times for QE and there are bad times for QE. Lots of people think it's just bad. It isn't. So you need to understand it, and you need to understand what's wrong in the way that people deal with quantitative easing. Nice little article, bit of fun for you, called Keynes Was a Monetarist, because I continually argue against Keynesians. Keynesians have got things wrong, and I explain why. They tell me monetarists have got things wrong, and they explain why. The important thing is that if Keynesians are right, monetarists must be wrong. If monetarists are right, Keynesians must be wrong, or they can both be wrong. The important thing is they cannot both be right. So never trust any economist who says, no, it's a little bit of Keynes, a little bit of monetarist. It's not. They're opposites. You can't have both. They're both wrong, or one's right and the other one's wrong. Now, Keynes started and talked about things in a very monetarist way. So if you read, say, a tract on monetary reform, it's basically monetarist economics. It's not till you get to the general theory of employment, interest and money, sort of the worst thing that he ever wrote, that you begin to get this separation which allowed Keynesians to go off on a tangent, thinking that they could manage aggregate demand and remove money from that. So it was no longer aggregate monetary demand, it just became aggregate demand, and we can spend lots of money and cut taxes and do all those wonderful things that politicians want to hear because there are loads of votes in it. So I like to annoy Keynesian economists by explaining to them that Keynes was actually a monetarist, not a Keynesian. So have a little bit of fun with that one. If you want more detail on measuring inflation, there's an article there which explains exactly that, which is the best measure of inflation and changes in the value of money. So you can go through what I say in your own time and work out exactly why RPI is better than CPI. There would be much better measures, of course, because RPI, one of the things not in RPI is asset prices or CPI. And asset prices are some things that absorb lots of the inflationary demand in the economy, particularly at times when you lower interest rates. So the booms in asset prices are caused by monetary expansions, but they're not measured in inflation because they're not included in the baskets. So you can read about that one. There's an important one, particularly if you think monetarism is great, which is you need to understand monetarism, because quite a lot of people criticise monetarism and say that monetary policy was terrible. Monetarism is terrible, isn't it? But monetarism isn't monetary policy. Monetarism is just one way to use monetary policy to get an efficient allocation of resources. So you need to understand what monetarism is. Don't confuse it with monetary policy, because 99% of monetary policy isn't what monetarists would say should be happening. There is my little article about the Bank of England and decades of mistakes. It's called What the Bank of England Got Wrong in the 1920s. Well, we know because they caused deflation. In the 1970s, we know because they allowed inflation. 1980s and 2000s, 2010 were often the way that they misused the lever that controls monetary demand in the economy, namely the interest rate. Interest rate manipulation was and has been a problem throughout these decades, right up to the current situation where you're sitting on a really big time bomb with interest rates at 0.1%, asset bubbles in the economy. How do we get out of this one? Well, I'm not sure I've got any answers here, but I'm exposing the mistakes of the Bank of England because, as I said in the one of the previous lectures, there is this people in awe of the Bank of England, and the Bank of England have done some good things, but they've done lots of other things, and there have been lots of mistakes that you really need to take them to task and argue with them. And before you do that, read that article, and that will be hopefully of help to you. There's an article there which is a reappraisal of interest rates and market interest rates, because interest rates are very much, and they have been since the 1980s, determined by the official bank rate or the repo rate, and they have been distorted to a low level at the secure end of the structure of interest rates. Now, I don't want central banks to influence interest rates. I want them to accept the market rate. So I explain what the market rate of interest is, and then say if the bank wants to get into the market by making loans, cash loans to banks, by selling, helping the sale of government debt, then it's got to accept the market rate of interest. And there is one, not manipulate that rate, because that rate is at the secured end for the actions that they want to take in the economy. They shouldn't manipulate that higher or lower than the market rate. If you want to read about that one there. We all know that there are problems with money, so this article just explains to you exactly that. It says what money is, what the money supply is, how the money supply can be created, how money is created, and how the money supply and the speed that you use it turns it into monetary demand. So that's what that article explains. I suppose back to a previous article, this is further development. The best way to complete a monetary reform and have maximum impact on the economy, that is benefit the economy to the greatest extent and have minimum change, is set out in this article. So if you're a central banker, you definitely want to read how you could bring about a monetary reform and have a maximum impact and have a minimal change. I won't go any further with that one, and then that might encourage you to read it. There's an article there called The Many Meanings of Liquidity, with a picture of my son and friends with one thing that they understand to be liquidity. I have made one thing clear during these lectures, that liquidity to firms normally is your access to money, your ability to pay your debts. Whereas to banks, liquidity is cash. It's not money, it's cash. The simple thing is, if I go to the cash machine at the bank, or you do, you wouldn't accept a cheque, you want cash out. Liquidity to banks means cash, but liquidity to every business other than banks is just their current account, their access to money. But there are a number of meanings of liquidity that are set out here, so that you need never confuse them when you're referring to liquidity in the future. Almost a whole lecture, I think 6, can't quite remember, I think it was 6, was to do with the difference between capital adequacy and liquidity. Capital adequacy being that you need to stop you becoming insolvent, and liquidity what you need to pay your bills. And again, some of the points that I've just made in the previous explanation on liquidity apply here. You need to understand this and not make mistakes over what you think capital is and liquidity is, and therefore what capital adequacy and liquidity is. Just a spoiler, capital adequacy, I'm quite happy for the Bank of International Settlements, the Basel Committee, to set capital adequacy regulations around the world that level the playing field between international banks. But I don't want central banks to be worried about that. They just concern themselves with liquidity. Central banks provide liquidity in the banking system. They don't have to interfere with capital adequacy. Read all about it. That's right. There's an article which is called The Quantitative Theory of Money for Keynesians, having a little dig at them. There used to be, or there still is, I'm sure, lots of explanations for how computers work for dummies, isn't it? This for dummies, that for dummies. Well, this is a little bit like that. Quantitative theory of money, very easy to understand. So I've dumbed it right the way down so that even Keynesians could understand it. So quantitative theory of money for Keynesians, you might find, is a little bit of fun. There's a critique of quantitative theory of credit. Richard Werner, who's a good economist, really good research economist, someone unfortunately I argue with on occasions because I criticised his quantitative theory of credit and he asked me to explain why, which I did. And then he came back on me. So I put it all into the article so you know what he said, I said, he said, so that you can read about the quantitative theory of credit, or at least my critique of the quantitative theory of credit. Central banks. I do explain once again central banks and the cause of the global financial crisis in 2008 and what I call the global economic crisis, which is going to happen now as the result of the pandemic. So central banks and what they did to cause these problems. The global economic crisis hasn't come out just yet. So if you read about it now, you can come back in a year and 2 years' time and go, we listened to you and what you said was a load of old rubbish. It never happened. Or the other way around. You might be prepared for what's going to happen next. Then there's deflation, which I've talked about in great detail in the previous one, and there's an article there called Deflation. What do I call it? That sinking feeling. Yes, so there's that one to read through. And then right up to date, there is an article there, what a disaster negative interest rates would be for an economy. Because if you're a Keynesian economist and you want to accommodate your fiscal expansions with monetary expansions, then you can lower interest rates, encourage people to borrow money, lower them, encourage people to borrow money, and you eventually get down to naught. And then you go, well, can't do it. Anything else, can I? And someone, yes, you can go negative. You can reduce it down to less than naught. No problem there. That'll encourage people to borrow money if you pay them to borrow money from you. It's a real disaster if you try and do that, as was lowering interest rates. You know, I consider bank rate at the moment any lower than 4% is a disaster, and we're down at 0.1. So read all about why I think that is the case in that article there. And then lastly, well, this is a big piece because there are, I really am clear that modern monetary theory is a mistake. It's really people who've just worked out lots of accounting identities and then tried to build a theory around these accounting identities which they don't really understand. And so I've put 4 mistakes and explained why. Their first mistake is that they don't know what the cause of inflation is. They talk about cost-push inflation, closing output gaps, Keynesian stuff, and they don't see hyperinflation as money printing. It's lots of different causes, supply shocks of one sort or another. As I explained earlier, they miss out step 2. All they're explaining are the things that caused printing presses to be turned on. It's always the same cause. Hyperinflation is printing presses. They don't quite understand the role of money in the economy. They think that when governments spend money, they create money in the economy. When they tax people, they destroy money because they can read an accounting identity here. That's not the case. And they don't really understand the difference here between money and income, because tax comes from people's income. It's just happened to be measured in money. It's not a case of money being destroyed and money being created. So I explain why they're wrong in that case. Equally, the rate of interest, they have this sort of view that the normal rate of interest would be 0, because in accounting terms you can create a 0 rate of interest, can't you? But no, the market rate of interest is that rate which gives a return to those people who want to save, and therefore charges people who want to borrow. So the market rate of interest is nothing to do with how the modern monetary theorists describe the rate of interest, and they're just a little bit off the monetary side and the banking and financing, but there's a fourth one in there, so I've got to include it. It's the job guarantee. They think you can guarantee jobs, and I explain why you can't do that, and I explain why if you really want to protect people, in another article I explain that you introduce reverse income tax. That solves all of your problems about basic incomes, universal basic incomes, job guarantees, those sort of things. They don't work, and so I explain why that doesn't work. So there are 4 articles there for you to have a read. So I will come back with individual lectures on miscellaneous topics. I better do one, having said it, on reverse income tax now, and I explain to people how that works. But basically you've got on YouTube 2 packages. One which is an introduction to economics, 10 lectures which will be used to introduce economics to undergraduates, and now you've got 10 lectures that will be used to introduce people to banking and finance. Some overlap because you can't avoid some economics in this banking and finance sector, but I've tried not to overlap too much. So if you wanted to watch all 20 lectures, you should find something new in every one. And you can go almost to lectures and standalone. If you're interested in one particular aspect, you can watch individual lectures, but it will be much better to go back and proceed through 1 to 10 if you really wanted a full understanding of all of this. So I hope you've enjoyed it, and I'll be back with a few miscellaneous lectures in the not too distant future. Thank you.